Have you ever felt like your student loan payments are taking over your life? Does it seem like no matter how hard you try, the monthly payments just keep eating away at your paycheck? If that sounds familiar, then this video is for you.
Financing college is very tough for millions of Americans.
Tuition has gone through the roof.
The student loan problem has reached epidemic proportions,
affecting approximately 44 million Americans.
There's something about the word student before the word loan that just makes us think about this differently, and differently in a very bad way.
There is no one that's going to stop you from borrowing.
Yeah, like when you want something really bad, you gotta take all of it.
Everyone has debt.
Today, we're diving into one of the most powerful strategies for taking control of your student debt, refinancing. Stick around because by the end of this video, you'll know exactly how to refinance your student loans, lower your payments, and finally get some breathing room in your budget. Welcome to Rise Above Debt, where we empower you with the tools and strategies to take charge of your financial future. Today's topic is all about student loan refinancing, what it is, how it works, and most importantly, how it can help you save money each month. If you're feeling overwhelmed by your student debt, you're not alone. Millions of borrowers are looking for ways to reduce their payments and free up extra cash each month. Refinancing could be the key to making that happen. But before you rush into anything, there are some critical details you need to know. Refinancing isn't for everyone, and if done incorrectly, it could cost you more in the long run. So stick with me as we break it all down step by step. Before we jump into the how, let's make sure we're clear on the what. So, what exactly is student loan refinancing? Simply put, it's the process of taking out a new loan to pay off one or more existing student loans. This new loan comes with a new interest rate, new terms, and a new monthly payment. The main goal? To secure a lower interest rate or a more affordable payment plan. Let's say you have 3 student loans with interest rates of 6%, 8%, and 10%. Each month, you're juggling 3 payments, and a significant portion goes toward interest. By refinancing, you combine those loans into one single payment, ideally at a lower interest rate, say 4% or 5%. This reduces your financial burden, simplifies your repayment process, and could save you thousands over the loan's lifetime. So, why should you consider refinancing your student loans? Here are the key benefits. If you have good credit or a cosigner with good credit, you're more likely to qualify for a lower interest rate. Over time, this can result in significant savings. For instance, if you refinance a $50,000 loan from 8% to 4%, you could save thousands in interest payments. Refinancing often lets you extend your repayment term, which can reduce your monthly payment. This is especially helpful if you're trying to free up cash for other expenses, like rent, groceries, or building an emergency fund. Tired of juggling multiple loans from different lenders? Refinancing consolidates your debt into one easy-to-manage payment, reducing stress and the likelihood of missing a payment. Refinancing lets you switch from a variable interest rate, which can fluctuate, to a fixed rate. A fixed rate ensures that your monthly payments remain predictable, making it easier to budget. Many borrowers rely on co-signers like parents or family members to qualify for student loans. Refinancing offers an opportunity to release your co-signer from the obligation, giving them financial freedom. Lowering your interest rate can significantly reduce the total amount you repay. Those savings can be redirected toward other financial goals like investing, saving for a home, or starting a business. Refinancing isn't always the right move for everyone. Here are scenarios where it could make sense. If your credit score has increased since you first took out your student loans, refinancing could help you qualify for a lower interest rate. For example, moving from a 600 to a 750 credit score might save you thousands in interest. Lenders look for steady income to ensure you can repay the loan. If you've recently landed a high-paying job or improved your financial stability, refinancing might be a smart move. Refinancing federal loans with a private lender means giving up benefits like income-driven repayment plans, deferment options, and federal loan forgiveness programs. If you don't rely on these benefits, refinancing could work for you. Managing multiple loans can be overwhelming. Refinancing consolidates your loans into one monthly payment, making it easier to stay organized. There are also situations where refinancing might not be the best option. If you're on an income-driven repayment plan or aiming for public service loan forgiveness, PSLF, refinancing isn't ideal. Private loans don't offer these federal benefits. If your credit score is below 650, you may not qualify for a lower interest rate. Focus on improving your credit score before considering refinancing. If you're already paying a low interest rate on your loans, refinancing might not save you much. In some cases, it could even cost you more if fees are involved. If you've decided refinancing is right for you, here's how to do it. Step by step, your credit score determines the interest rate you'll qualify for. Use free tools like Credit Karma or your bank's credit monitoring service to check your score. Don't settle for the first offer you find. Compare rates and terms from banks, credit unions, and online lenders. Pre-qualifying gives you an idea of what interest rate you're eligible for without impacting your credit score. Look at interest rates, repayment terms, and any associated fees. Choose an option that balances affordability with long-term savings. Submit your application with your chosen lender. Be prepared to provide proof of income, personal information, and details about your existing loans. Read the terms and conditions carefully. Watch for hidden fees, prepayment penalties, and other clauses that could affect you. Once your old loans are paid off, you'll begin making payments to the new lender. When you apply for refinancing, lenders will perform a hard inquiry on your credit report, which can temporarily lower your score. However, refinancing can improve your financial health in the long run by reducing your debt-to-income ratio and making payments more manageable. Before committing to refinancing, ask yourself these critical questions. 1. Can I qualify for a lower interest rate than I currently have? 2. Will I lose access to any federal benefits I'm currently using? 3. Am I comfortable giving up income-driven repayment options? 4. Do I need the simplicity of a single monthly payment? The biggest mistake is accepting the first offer. Always compare multiple lenders to ensure you get the best deal. Hidden fees, prepayment penalties, and unfavorable terms can cost you more in the long run. Read the loan agreement thoroughly before signing. Refinancing is a major financial decision. Take your time to weigh the pros and cons and ensure it aligns with your financial goals. Refinancing your student loans can be a powerful way to lower your payments, reduce your interest rate, and simplify your financial life. But it's not a one-size-fits-all solution. Before you make the move, weigh the pros and cons, consider your current financial situation, and ask yourself the tough questions. If you're ready to take control of your student debt, start by checking your credit score and shopping around for lenders. With the right strategy, you can rise above debt and put yourself on the path to financial freedom.